So now we want to go deeper into the small business data that has come out. And the reason why we do so much on the small business side is because the US economy is driven a large amount by small businesses. So it's important to see what are they saying, how are they interacting with their clients. So the December small business optimism index fell to 89.8 versus the estimate of 91.5. Outlook, which is the orange, we hooked back down and remains well off. So sales expectations dipped, inventory satisfaction rose, and capex expectations eased again. So when you look at business conditions, so this entity was started back in 2001. I mean, we're still at record lows on general business conditions and the outlook for it. Optimism has come down to where we were during the great financial crisis. We're actually now back below where we were during COVID. So there's clearly a concern at the small business side, even though some of their costs eased when you looked at supply chain, when you looked at inventories, when you look at gasoline and some big inputs. And then the small business leading indicator versus ISM gives you an idea where it's turned back down and there's more of that to really fall. And it just shows that the ISM manufacturing PMI, which is already negative and in contraction, going further down and getting further, and I think really closer to that 40 level over the next few months. Now, when you look at the sticky CPI, so the sticky CPI, it appears that wages, which is orange, and CPI X shelter have peaked. But what matters as well is what rate they settle and how long it takes. And again, it's going to come down to the rate of change. Where is that rate of change going? And one of the things that we've seen when you start looking at the blue line of CPI, well, wage growth was able to get a bit above, but we see wage growth coming down a bit. And remember that CPI, especially the sticky CPI, core sticky CPI, flatlining, which is why we think there's going to be a bigger problem as we moved over the horizon, with trimmed mean inflation metric tracked, confirming rolling over in inflation. But again, it still was at 6.5%. So when you go back to 1979, you're looking at the trim mean still at an all-time high, which is why we continue to see this pressure point. And technically, when you start looking at wages and income, we're still negative in terms of wage growth adjusted for inflation. So that's why you're still negative. You're still seeing people now increase their usage of credit cards, and it's now at an elevated at a rate that has set a new record. Now, as pressures fall for small businesses, plans to raise prices over the next 3 months have also come down. So when you look at the yellow line, it's come down. It's still at one of the higher levels going back to 2000, but you're starting to see some of that come down a bit. And that's a positive for some of these inflationary pieces in terms of where pricing is. But when you look at job openings hard to fill, it's rolled over again, but still elevated. So then when you look at hiring plans continue to come down because the cost is too high. So the question is, are prices going to come down faster than wages? Because this is telling you that I'm not hiring anymore. Or less people are hiring at this point. Therefore, it's going to continue to drift lower, which will put more pressure in that backdrop. Employee compensation in small businesses moved slightly higher in December, but plans to raise compensation continued to tick lower. So again, there's that back and forth there's a lot of this disconnect in terms of wages. Some wages right now have gone up, but then wages in the future are expected to come down. Now, an employer can say that, but then when they go to hire people and they may need someone, even though you don't plan on paying them higher, you're going to have to, or you're going to still have to pay them more than what you expected, less than what it was now, but it's still seeing some of those upward pressure points. Number of small businesses seeing higher prices with the blue has fallen sharply, as poor sales only moving higher marginally. But the clear, sharp increase in prices did not cause an immediate revenue issue. But look at higher prices. So yes, higher prices coming down, but going back to 2000, we're still at a record level. We are off the peak from 2001 from 2021. That is what we expected. but we also see this lagging piece, which is going to continue to keep that problem elevated. And again, put a little bit of that floor that we've talked about in pricing and underlying inflation. Slowdown in wage growth has been confirmed by the latest update, wage tracker in blue, but there remains a large gap between average hourly earnings. So again, it's what are we looking at? What market are we looking at for wages? Because obviously income and compensation is going to be a very important piece of how much is the U.S. consumer going to continue to spend? How much are they willing to put themselves further into debt? How much are the increase in credit card rates going to impact, some of that conspicuous spending and spending as we go into really key periods of the year of travel when you think about the summer? And a lot of, and again, not all, but people start to plan their vacations now because you need something to look forward to when you're sitting in the doldrums of winter. As we get to the end of January and February, people are like, all right, well, let's start planning our June or July vacation to give us something to look forward to. That's going to be difficult right now. And unless we get some bigger sales and some other types of incentives, that's why we think there's going to be a bit of a lull and not the same type of activity that is hoped for as we go into Q3. Now, clear that CPI inflation has rolled over, but at the same time, there hasn't been any meaningful spike in initial jobless claims. So when you look at the different pieces, the jobless claims, again, when you look at some of these movements, we should start to see some of these adjustments. And that's why the CPI side, we think, again, it's come down in a nice way, but just look at what the year over year was as you have the acceleration in January of 2021. So when you look at the year over year, the comps are going to get harder, which is going to show a reduction now. But again, when you look at more stable data, especially year over year, but really month over month in these 4-week moving averages, we're not going to see the same type of knockdown. And that's where we want to caution people when you look at, the Fed's going to pivot because year over year came down. Look at core, look at month over month. Once that starts to roll, the question is going to be, at what point will they start to pivot as that rolls down? And we don't think that's going to be very quickly. And realistically, we don't see that happening in 2023, at least a pivot. We do think we'll get some deflation as we go into Q4 of this year, but that's going to take time to develop. January update sentiment showed a slight tick down in the percent of individuals expecting more unemployment in a year, but you could see that the share is still hovering near recessionary territories. So again, University of Michigan not telling us anything we don't already know. December headline CPI came in at negative 0.1 versus the estimate of negative 0.1. Core CPI came in at 0.3 versus the estimate of 0.3. December headline came in at 6.5 versus the estimate of 6.5, with core, again, staying that elevated side. And that's when we can't stress enough, because when you look at core CPI, you're actually getting an acceleration. The previous month, it was 0.2. Now it's 0.3. And you're starting to see this ramp back up. And we actually, again, not to say that the core CPI is going to get to 0.5 again. There's a lot of staying power at that 0.2 and 0.3 level, giving way to more of that stagflation as the economy gets worse. But you see a lot of that stickiness at the core level. And then you go back to 1960 to see 3-month annualized change on used cars and trucks. So yes, the used cars and trucks have come down, but when you look at used car and trucks overall at the top, you're starting to roll over, but still elevated. The issue is people have locked in loans at these levels. So as prices continue to fall, which they will, how are you going to backstop some of these? And which is why repo rates are going to start going up. Goldman Sachs has said they're starting to see more cracks in how they track the consumer. You're starting to see more repos. There's going to be a much bigger issue in general. CPI month over month core goods came down, but core services. So as we've been saying, core goods is going to continue to come down. Again, not a huge number, but it's going to be negative, while core services is going to be up. The problem is services makes up 70% of buying versus 30% for goods. And the services is sticky. That's what's going to keep the consumer tied up when you look at how they're going to spend. Now, when you look at core goods CPI seeing the rapid disinflation while core services is taking longer to roll over, actually moved higher, we don't see services rolling. And that's the key piece of why we see the service side and why we talk so much about those issues to the underlying market. 3-month annualized change for CPI services back down to 1.2% positive, which is slowest rate since summer of 2020, but still positive. 3-month annualized change for core has rolled over relative to 3.1%, which is back to where it was in September of 2021. Now, those rolling 3 months, again, the comps get harder, get easier in terms of where we are, but you're still seeing this elevated number on the blue line. So even though you're going to get some of this rollover, you're still getting a lot of stickiness to what the consumer sees when they actually go and purchase an item. In month-over-month terms, owner equivalent rent saw gains re-accelerate in December to 0.8% month-over-month. Owner's equivalent rent portion of CPI continued to rise 7.5% year-on-year. So again, if rent and owner's equivalent rent is 42% of the CPI data and it was at 7.5%, that means that you had to have things move down more than 1% to average 6.5%. And again, when you look at the ratings and the weightings, there's some magic math happening in that backdrop. But perhaps no surprise, but expectations for credit conditions among U.S. small businesses have fallen to the lowest or worst in a decade. And it's because rates are so high. Why am I going to borrow? Which again results in less CapEx, less spending, more pressure. So then the small business optimum index and the consumer confidence, you can get the separation, but we do believe that they're going to move into the same direction. Still a large spread between wage growth for job switchers and job stayers. And then when you look at the index, it's just because people are looking to switch because they can get a better price somewhere else. While inflation easing trend in real average weekly earnings has improved a bit, 3-month annualized percent change has gotten out of deep negative territory. But the rub is that there still isn't meaningful growth. So as you can see, as we've been talking about, real wages are still negative, and we don't see that going positive in the near term. Trying to get a true core view, worth watching key slowdown in CPI less food, energy, and shelter, which is now seeing its slowest, most negative 3-month annualized percent change. But when they're taking out a lot of things that people spend on a daily basis, both food and shelter. So that's where it's like you could say that, but how are people really going to spend? And that's where we see that people want to try to spin that narrative, but we still see a lot of that stickiness. Food inflation has hopefully peaked. A component within CPI has seen year-over-year gain move down to 10.4%. Recent high was 11.4%. But as we said in segment 1, we see this as more of a long-term issue and not coming back to the levels that we've seen, but really remaining elevated based on those pricing pressures. Wholesale inventory sales ratio has swung back to where it was in the summer of 2020, also consistent with average leading up to the pandemic. So again, you're starting to see inventories normalize. That's going to reduce the impetus of them to go out and spend more, buy more things, and that's where we see more of that slowdown in terms of new import orders, new orders, which was why we see more pressure on the emerging markets, not less, because we don't see their orders improving. Household cash balances across the income distribution. This is where, as we've been saying, a large part of it in terms of household cash is held at the top. And that's where it's going to stay. We don't see that getting released into the market, especially given the pressures there. Share of discrepancy spending and total spending per income, remained resilient across different income components. But when you start factoring it in, especially adjusted for inflation, a lot of this is coming down. You're seeing more pressure, not less, which is why we think that we've already seen the peak in retail sales, and there's going to be more downside. Empire Manufacturing Index plunged to negative 32.9 versus the estimate of negative 8.6. New order to 31.1. Hours worked fell to negative 10.4. Prices received and paid fell, still expanding. The 6-month outlook improved slightly, but you see here just how steep that drop is and why we remain so concerned for the economy at large. If Empire New Orders Index is any indication of where ISM New Orders will come on February 1st, and there's always a correlation, it's going to be one of the sloppy ones. So negative 31.1 is the third worst monthly number since the survey was created in 2001. Again, a lot of pressure there, with prices paid still coming down, but again, still staying elevated and in expansion. Now, when you look at the big drop, and this is looking at all related indexes for the ISM PMI, here you can see that there's a big drop in the Empire State Manufacturing, and typically they trend in the same direction, and that's why you can see the lumpiness within them, but they're trending down. And just when you look at the average, there's nothing to say that ISM is going to bounce negative once you factor in all of these key pieces. When we look at University of Michigan Consumer Sentiment Index, bounced to 64.6 versus 60.7. Current conditions bounced to 68.6, but you're still bouncing off lows. And a lot of that is driven from gasoline, but overall, we don't see a huge benefit going forward in some of these flows in general. Then when we look at existing home sales, there was that divergence over the past couple of months for new and existing. Existing came in at negative 5.9%. New came in at 8.2, a positive 8.2%. November existing was at negative 7.7%. New was at 5.8. So again, you're starting to see that divergence, and it's just, what are people willing to spend? Are they getting incentives from the builders to buy the new homes? And that doesn't get picked up here. And I think that's a key component of, well, are they getting incentives to buy new? Because essentially the construction companies, the builders are like, I need this off my sheets, take it. Perhaps no surprise, but percent of homes selling above their list price has fallen to just below 30%, which is way below the peak, which again, not surprising given the pressure. Median new home price increased by 9.5% year on year in November to 471,200. Annual growth rate is obviously well off peak, but still strong, which is why there's still way more downside in the housing world. U.S. mortgage applications spiked by 28% last week, largest percent change since March 2020. But applications peak doesn't mean you're going to get the application. Doesn't mean it's all relative. This is a good data point. I'm not discounting it, but we have to see some follow through before we can say that there's going to be a change. And all of the other data points are saying that there won't be. 44% year on year drop in mortgage purchase index is the largest decline on record. Again, coming back to what we were saying previously. Clear rolling over in job openings across the board with the metrics for small businesses and broader economy. So you have job openings rolling a bit, wages not growing, inflation elevated. No one's buying a house at these prices. So again, more downside on the housing front. So that's what we have for you in the US. In the next segment, we're going to go deeper into Europe and some of the components that are shifting things a bit better there.